Good day, guys. I trust you are all well. I'm doing very well. So let's have a look at what we're looking at in terms of opportunities. Now, I talked to a lot of traders about these 7 markets that I trade. And I think it's important just to understand how I juggle them in my mind. How I stay sane, not go crazy. So 7 markets, here's how they're structured. Now, I am in South Africa, Central Africa time zone, which is GMT plus 2 hours. So just need to make the adjustment. Let me have a look at my clock and just tell you. So where I am in South Africa, New York is 7 hours behind, London presently 2 hours, Singapore is plus 6 hours, Tokyo plus 7, Sydney plus 9, what else? Okay, that's probably sufficient for now. Auckland plus 11 hours. So this is where I'm trading from. So the way I manage my trading day is that in the morning, my morning time, I prefer to get up and be in at the open of the Hong Kong Stock Exchange. So I trade that first part of the Hong Kong Stock Exchange, and I'm trading the Hang Seng 50. Now, you would know that, so my time, market opens 3:15 in the morning, and that first session closes at 6 a.m. And I find that there's huge opportunities in that particular part of the trade. And of course, there's a couple of other sessions and all the way up to 9 p.m. my time. So that's what I primarily trade in the morning sessions, okay? Doesn't mean I don't look at anything else based on what's setting up on previous day, but my focus is trading that Hong Kong Stock Exchange open. So when we come up with something that we're working on with Paul and the guys, ATW, we'll be talking about trading live this particular sessions. Then when I get to the European session, European London Stock Exchange session, European session, I'm then primarily looking at Euro versus the dollar, gold, and UK 100. So we're going to look at that at the present moment and see if there are opportunities for us, and there are opportunities, a bit of waiting. Then when you get to the afternoon session, there is the overlap of the open of the US markets anchored around the New York Stock Exchange, the US markets. So my time, New York Stock Exchange open 4:30 p.m., which is 2:30 p.m. presently, UK. And those first couple of hours are very important because of the overlap with the close of the European London Stock Exchange. In the afternoon, I am then looking at the S&P 500. So I'm actively trading the S&P 500. Fits well with my time frame. I've done my school runs, back on my desk, and I can focus on trading the S&P 500 until the New York Stock Exchange closes. And I also trade at that time the Nikkei 225. So that's how I kind of organize my day. Then, of course, I've got Bitcoin on my charts after dropping oil. And when Bitcoin sets up, when I see the setup, just jump in and trade. So I'm always looking at that. So with that in mind, I want to look at Euro versus dollar. I want to look at gold, UK 100. If we get time, I want to show you a setup that we had a couple of days ago, Monday setup. Yesterday's trade, which in the early morning session turned out very well. 5-to-1 return on the trades that I took. But let's see if we get there. Euro versus dollar. We have talked about this token. We have spoken about this many times. This double top, this failed breakout, confirming that level of resistance. Now, what I have presently, we have an inside candle yesterday, okay, after this doji candle, which was follow through. Bears broke beneath this doji candle. Any break beneath the trading range is likely to fail. Most breakouts fail. So fantastic. If you had jumped into the following trades, you should have been anticipating a failure. So this trading range here, tails on top, tails on bottom, not a surprise. Inside candle, breakout mode, but breakout mode out of a trading range. And again, most breakouts fail. So inside candle yesterday, inside a trading range, breaking out of a trading range. So I'm expecting fail, that breakout to fail. So I'm looking for shorts. And if a short materializes and we have a bear candle today, or a candle close on this low and a bear candle follow through day, we're going to say, oh, fantastic, we have a lower high. But what we want to do is anticipate these things. So as this thing is forming, and we're looking for that reversal trade, we're going to be right. 60% of the times will be 100% right, which means we can fail 40% of the times. But I'm looking for shorts here. Now, what is going to be the trigger for me to jump into the shorts? Okay, I've got a couple of things which I'm going to drill down to the 5-minute and explain to you what they are. But for now, have a look at with me. This trading range here, okay, tail on top, tail at the bottom, small body, that's a trading range, okay, within a trading range. The low of that trading range is, on my charts, 1.13744, is this light blue line. Okay, so that was a breakout point of that trading range, which now the market coming up is a level of resistance. So that's going to be a key level to look at on my 5-minute time frame. I've left it up there so that we can see it. So it's a breakout point. Now, so that's one thing. The other thing that is significant is this bear candle here. Strong bear breakout beneath that trading range, beneath all of these lows, close beneath the 10 moving average, which we use to indicate the strength of a trend, and also close beneath the 20 EMA. So very strong bear candle. If you have a strong bear candle, strong bear breaker, whether it's a full day or if you are in news and you're waiting for the news and you stand back out of the market and you end up with a huge bear candle, or it could be a huge bull candle, the 50% pullback is a magnet that you always need to keep in mind. So I have marked for me here, for the purpose of this, there is a high, there is a low, 50% pullback is that. So that's a key level of resistance. The breakout point beneath the trading range, key level of resistance. So when I get down to my 5-minute time frame, those levels I'm going to be watching to see how the market responds to that, because that might give me an opportunity for me to go short. If the bulls are strong and they completely ignore that, then I'm going to want to see what happens here. It's still looking short. Now, if you trade, there's many ways to trade price action. Some guys always want to trade always in. They want to be constantly in the market. If it's going up, they want to be in it. If it's going down, they want to be in it. If it's a trading range, buy low, sell high. Just know where to put your stop. I don't want to trade like that. I want to look at the market and say, what do I think is likely to happen with this kind of setup? 60% of the times this is likely to happen. That's what I want to do. Then I want to go look for my opportunities. Okay, so I'm going to drill down to the 5-minute on this time frame. Let's have a look at, I took a blind limit order on euro. Fantastic. So if you're doing that, it's probably actually not blind. Point is, you got to decide where to put your stop, right? Your stop always has to be in a technical level. If you are trading, for argument's sake, the daily market, and you kind of say, listen, I'm going away, I'm going to be so busy, but I think the market is going to go short here. I'm just going to go and just sell. You sell, fantastic. Where do you put your stop? Your stop has to be up here. That's where you put your stop, okay? You in the middle of the trading range. If you think, hey, market is going to go long, I don't have time to come back and check after a few days, I'm just going to buy. Where do you put your stop? You buy, you got to put all the way down here. Okay, so always stop is the most important thing. So now let's go to the 5-minute time frame, keeping in mind these levels of resistance and support. So I'm looking to go short. Here is how things are turning out for me. So remember, always green line, high of yesterday, red line, low of yesterday. and you just prolong the high and the low, and there is a 50% pullback. Okay, there is that. So ignore this. Remember, we marked that bear candle. So you want to just ignore that. Otherwise, it might just get a little bit confusing. That blue line we spoke about, the low of the breakout point of that doji right here. Okay, 50% pullback right here. Let me put it up again just so that we can quickly see it and just as a refresher. Okay, so that light blue line, it's low of this doji candle. The 50% pullback, that level is the 50% pullback of this breakout candle. Okay, that line I'm saying ignore is just that low. Okay, so let's go back to the 5-minute, and now we've got information, level of resistance. So why would we be surprised if we see a huge bull candle and the market starts to go sideways? You don't need to be surprised, because now you know there's a level of resistance. This was a breakout mode, the breakout point of that doji candle. Okay, so fantastic level of resistance. We expect price action. There is a 50% pullback. So if the bears who broke beneath this low are strong, they're going to defend this. If the bears who created that huge breakout candle are strong, they're going to defend the 50% pullback. Because 50% is a magnet, which if you look at all trend bars, breakout trend bars, the market comes back to the 50% point the majority of time. So we always want to watch out and look out for that. Okay, so I am at this stage perfectly happy. The market has failed to break decisively above that breakout point and above the 50% pullback level. I have a strong bear candle, bit of a follow through. Okay, we're back in that range. So my bias, my mindset, 60% is still short. What am I waiting for to jump into the market? I now want to see a double top. Okay, so I want to see one of many things. If the market comes back and tests that, the market, the bulls are saying, hang on a second, yeah, we see all of that, George, but we have so much strength, we're going to break above that. Okay, so I want to see a resumption of this trend, because I need confirmation that the bears are actually going to take control of the market. So I want to see if the bulls are able to resume it, get to here, and let me see what's going to happen. So one of a few things can happen. We can get a double top here. Then I'll be happy. Tick, second tick. I have that failed breakout. One, I have a resumption of the trend. Now, here's something else. One thing you got to look at, you're not just looking at a pullback and saying, okay, let me see a resumption. I want to see that the bears are strong enough. After this strong bull breakout, the bears are finally strong enough to put a full candle, couple of candles below the moving average. So that's good. Okay, so we call that the moving average gap bar. So bears are strong enough to do that, but let's see if the bulls can come back into the market. So a trading range has been formed. I want to see what's going to happen here. If we get a double top here, this top and that top, could be a perfect double top, could be a lower high double top, could be slightly higher high double top. It doesn't matter. It could be any of those variations. If it's perfect double top, well, even better, right? So it could be a lower high double top here, perfect double top, a higher high double top, and within that region is perfectly fine. When I see that, boom, first tick, second tick, third tick on my things, mental checklist, then all I want to see after that, with proper separation, remember we said separation must be at least 5 to 6 candles, 30 minutes of price action on the 5 minute, so you can go away, go have some coffee, go check out the sun or the clouds, depending on what you got, what weather you've got. Come back and see what happens. Lower high, get a setup, take the trade, and we'll talk about where to put the stop. Okay, so one of those, lower high, perfect double top, or just slightly high high. Alternatively, market can get there bounce off, and instead of giving us a setup, you just get bear, bull, bear, bull. That's not exciting. Off the double top, you want to see a succession of strong bear candles in the lower high. So if you get more trading range price action, even though the price is going down, you just have to be patient off that double top, wait for another resumption, which means the bears are not strong enough to give you successive bear candles. The bulls can resume. And if they do that, let's say we now get a bull resumption somewhere up here above these lower high double tops, etc. Perfect, even better for us, because anytime you have a double top and you have a failed breakout above the double top, if the market then turns, that is a variation of a wedge pattern. A wedge pattern is 3 pushes in the direction. So attempt to break above a level, fail. Attempt to break again, fail, giving us some variation for double top. Third attempt, that fails again. You gotta be now just jumping in the market when you get a lower high, because a wedge pattern with all these ingredients we're talking about, you gotta have the ingredients, okay? So you can't say, well, 1, 2, 3, that's a wedge pattern, I'm gonna sell. Okay, that shows, yes, potential failure, but you need to see the bears closing beneath the moving average. So if we get that form in here, we take a sell here, we take a sell anywhere down here. So patient, wait for it. If it materializes, it can be a beauty, because you can get into a trade, trail your stop to a one-to-one level, get a pullback, jump in the trade, and who knows. Okay, so we are waiting quite patiently, and it will come. Gold. Okay, let me take you through gold. We might have time to have a look at Hang Seng 50. I think we will. So gold, again, we have spoken about these levels. Okay. Now, here's an interesting pattern, which is very important. I think if you're in on Trading Buddies, we kind of spoke about it as well. Double top that is formed at this point. You had market going up. So don't worry about the red and the green. That's high of yesterday, low of yesterday. With a pullback, with another resumption. Before we had yesterday's candle, we had one push up, second push up, third push. At that point, you've been asking yourself, and I remember speaking with Jeff and Ash to say, well, this is a sell zone. Okay, you would have seen that and say, well, what is this guy talking about? Can't you see all this bull candle and that bear candle and that bull candle? Why would you want to be sell? Because we look to the left. You cannot ignore that price action there. Complete failure at that price, in that price zone. Okay, strong bear breakout and follow through. And these 3 pushes up is really an attempt to break above that. That's a wedge formation. So their alarm bells should have been going to say, hang on, there's a potential setup coming up for us off this level. Now, the market did not reward us with a decent enough reversal candle. There would have been opportunities to get in there if you're watching it, but let's not worry about that at the moment. But we now have an outside candle. Beautiful trading range forming in the very same area that we did trading range. Now, seeing that, you gotta be excited to say, okay, I gotta be looking for shorts here. Okay, and how do I look for shorts? You put in all the potential levels of support and resistance. Okay, so that's the low of yesterday. That's the high of yesterday. There is the midpoint of this outside candle. Outside candle is a trading range. Okay, so you want to find the midpoint of that trading range, because in the midpoint, the market gets pulled to the midpoint of the trading range. You want to see what happens there. So we have that level. We're going to leave it in. Looks a bit cluttered. I'm going to go down and show you on the 5-minute time frame what else we're looking at. So keep that in mind. So in this whole area, we are looking for shorts. Even if you just say, okay, I'm looking for the simple things to do. Okay, I'm not gonna try and get in early. I'm just gonna wait. So you see that outside candle, leave it, close your gold chart, come back and look at it at the end of the day and see how today is formed. It could just be an inside candle, or it might turn out to be a test of that 50% pullback and closing near its low, which is near the bottom of that trading range. Then you got to come and think, the bottom of a trading range, will the bears be strong enough to break beneath this? But I know break of a trading range may be a pullback. Let's look for opportunities to still go short, but let's be careful. Okay, so let me finish that thought. So you can just leave that and come back and say, okay, not interested. Next day, come back and maybe we may be up here, bouncing off here and failing to break over and say, okay, now I can jump in because this is a controlling force, this outside candle, this trading range in that zone. You want to just try and find opportunities. There's an outside candle, you don't want to trade beneath that. Then you see that candle, you want to try and get into that. If you don't get into that, you want to see that candle. The opportunities will come, but this is a fantastic sell zone. Okay. If you want the easy stuff, wait for it. If you want to look for the reversal trade, let's go in and see. Okay, let's just do this as a recap. Okay, high of yesterday, low of yesterday, just makes a little bit precise. Okay. Height of yesterday's trading range, midpoint level. That's what I'm looking at present to say the midpoint of yesterday's trading range is likely to be tested. So I'm waiting to see if I will get a setup of that midpoint. If I do get a setup, I'm definitely going to take it and watch it and see if the market can track all the way down. And let's see how far the day goes. We might end up back at the midpoint, get out of the trade, take a bit of profit, or we might get acceleration. But the key point is let's not rush it. Let's wait. Okay, so here's a few other things that you can put in while you wait. So you see this here, high of the day, low of the day in the Asian session. So that's a trading range. And of course, you got to ask yourself, I can see that trading range. If I'm a bull and I break above that, where do the bulls want to go? Okay, we don't get surprised when we use measured moves. So now when you see all of that happening, okay, so if you were trading always in, so price action traders either wait for your patterns to set up, like I prefer doing, and then you execute when they come up. That's how you get your traders equation working for your risk, reward, probabilities. You got to execute the strategy so that the 60-40 works for you. Okay, or if you trade in reversals, the 40-60 works in your favor. So if you trade in a reversal trade, like I'm waiting to set up, okay, I know that 40% of the times, even if it sets up clearly, the market may continue to go up. So I've got to manage my trade and get out of the break even, or I might get stopped out. But if that trade sets up perfectly and I'm patient and I execute it, that 40% of the time that I execute it well, the rewards far exceed just taking bits and pieces up the market. But if you're trading always in, every time the market goes up, you jump in. I think Alfia says he just took it. I think he said, what was the word you used? A random entry, but I don't want to think of it random. I would like to think of it as if I'm trading always in. The market is going up. I need to find out where to put my stop. Okay, I'm taking a breakout above the trading range, where is the technical level down here, take the trade, manage it, and until you get to a measured move. Why is the market doing what it's doing now? Well, there is a height of the trading range. Okay, so when you get there, profit taken, because that was the objective of the bulls who are trading that. So that's a key level that you need to watch. I'm not in the market. I'm looking to go short. So I'm seeing all of that. I'm saying, okay, we had a pullback here. Bulls closed. So I've got that measured move. Here's another trading range where the bears showed a bit of strength. So I mark the high and the low of that. High of that trading range, low of that trading range. What's your objective of the bulls taking trades here? They want to get to that measured move. So levels of resistance are beginning to show themselves. Okay. And they're keeping up building a story. Remember, this is the 50% of yesterday's trading range. So the market can still go up. I have no problem with that. I'm waiting. All these factors are building up in my favor. Okay. And I mean, I can eyeball it, or you can put in and just have the assurance that these measured moves are working. That high, that low, bit of a trading range here. So you can just see multiple factors building in that resistance level. Ultimately, that's where I want to get in. I'm looking to sell. I want to sell as high as possible, but I need to see things setting up. So yeah, I see these resistance levels. First time that I have the bears closing beneath a moving average, they were not able to put a candle right beneath the moving average. So I haven't seen a moving average gap bar yet, as we call it. In all of these resistance levels, I want to see a couple of strong bear candles. Now I want to see a complete candle that is at least beneath the moving average. Then I'm happy, chappy. I start to tick my boxes. As it is, I am waiting, still thinking short and waiting for the setups to come. Okay, so wait. Now, waiting, I think someone asked the question, do you have to keep looking at the charts all the time? You don't have to, you can go away. Okay, remember I've spoken of separation. Whenever something appears, I need to see a separation for at least 6 candles that confirms for me that a level is holding or a price has been agreed to. So if I'm here and I'm saying it hasn't set up yet, I still need to see those strong bear candles closing beneath the moving average. Then I need to see a resumption, a double top, and a lower high. And I know I need to get 6 candles separation with, between price actions. So between that, market coming down and the double top, at least 6 candles. So that's 30 minutes. Then I want to see a lower high, at least 6 candles separation. So I can just disappear for an hour and come back and have a look at my charts and say, oh, it's set up or it hasn't. You may say, but hang on, George, what if while you're gone, the market has a strong bear candle and another strong bear candle and another strong bear candle? Man, you have a strong bear breakout. You're not in the market. Well, I am still perfectly fine because I'm not going to trade the breakout. I'm going to wait for the pullback. And again, I am into my 6 candle separation. If a pullback sets up and triggers while I'm away and I come back after my hour, with the pullback, fantastic. I have a lower high. Now I'm just going to wait for the second lower high. So there's always opportunities in the market. So the only reason you probably would sit all day or during a session is you're kind of looking at the euro and you're saying, oh, okay, what's happening with the euro? So now, we were hoping to get, double top, lower high. We're not getting that. What we're getting instead is market still going down, which is fantastic. We're getting, what's the time now? Okay, there's 2 minutes to go. So unless the bears give us a strong bear candle, it's just more trading range price action. So we're going to test the high of yesterday. Am I going to sell? I'm not going to sell. I'm still going to wait for the market to come and give me double top, fail breakout, whatever. So we wait. Gold, we are waiting. Okay, just check questions. UK 100 is the other market that we're looking at. Okay, so again, inside candle, there is a big outside candle. I've just marked that low and that high. Green is high of yesterday, low of yesterday. Failed breakout we have up and against that. And good bear candles. Okay, so failed breakout, we had a bear candle, we had a follow-through bear candle. Now we have an inside candle. what's your bias? Are you going to buy here? Okay, as thinking that the market is just going to accelerate up. So if you're thinking, hey, hang on a second, the bulls are strong, they're going to come back after that correction. And I really think that the bulls are just going to accelerate up. So I'm a bull, I'm going to buy. Well, if you buy there, you have to put your stop at a technical level here, or you could be a little bit more aggressive and put it here. You can't put your stop on the reversal candle. Okay, that's if you're a bull, but I doubt very much that many bulls are thinking that way, because you can't ignore the failed breakout. Okay, it's a double top, it's a high double top. You can't ignore that. You can't ignore the big bear candles, although, we have an inside candle here. This is an inside candle, and the bears, yes, they closed beneath moving average, and they failed to go and close beneath its lows, and they got the this big level of support here, which if we go onto our monthly chart, we can see a high of last year is a big level of support. So we are looking to go short. And again, here is the thinking. Market is coming off that level. So you've got to be looking to go short. There is a 50% pullback. Let's go down into the 5-minute and see how we can jump into a trade. So we have a problem here. This high, remember, is a high that we had from a couple of days ago, that high. So we've got yesterday, previous day, so perfect market is bounced off that. So that level is well defended. Remember, we're looking to go short. So we have a huge bull candle, big tick, bounced off that. What are we looking for? We're looking for a confirmation, looking for a double top. We need to see successive bear candles. So coming off that failed breakout above that high and test of that level, we wanted to see strong bear candles closing beneath moving average, possibly give us a moving average gap bar. We don't get that, we get sideways price action. So there is no legitimate place for you to jump into a trade here. So you wait. And you'll be waiting to see if you get a double top, but unfortunately, you don't get a double top, get this huge bear candle and say, okay, maybe the bears are strong. Let me see if the bears are able to give me a follow-through candle and close beneath the open of the day, which starts to create the possibility of a reversal candle on the daily. And if they do that, get a pullback. We don't get that. We get the bulls coming back, and we are back in the middle of the trading range. You don't execute any trade in the middle of the trading range. So no lower high that you can trade. But down here, with the potential of a double top, bears creating some price action, we don't sell at the bottom of the trading range. So we're going to have to wait for a few things to possibly happen. If the bears are strong, okay, and we haven't had an opportunity to get in there, which is perfectly fine. If the bears are strong, they need to give us a strong candle breaking beneath the open of the day, start to change the structure of the market. Then with any breakout beneath the open of the day, beneath this low and that low, we need to see a follow-through candle. So if this candle was to close on its low, okay, we then need to see another bear follow-through candle. Okay, and if we see that, whatever size, but a full body node, tails or very small tails, then we're happy chappings. Then all we want is then to see a pullback that will test that breakout point. And if the bears are able to turn the market again in terms of defending the open of the day and give us a lower high, then we jump into the trade. We've got to find where to put our stop. Our stop is going to be up here. But at the present moment, have a bit of coffee, hide your frustration to say, man, I mean, just give me a nice setup so I can jump into the market. It's always beautiful when you get this setup, because then you just sit there, your mindset goes to money management. How much am I risking of my equity? Argument's sake, 1%, execute the trade. And the way that I trade, when that 1% is at 1-to-1 and protected by a trail stop, I've got 1% banked. I was happy to get stopped out at 1% to minus 1%. So if I got 1% banked, protected, not mentally, but protected by a proper stop, then I'm now in money management mode. I can put 2% into the next trade, because if I'm wrong and I get stopped out, I minus 2% on that trade. I've banked 1%, and I minus 1%, which I was comfortable with in the beginning. Okay. And if we continue, and of course that 2% is locked, gets very exciting. Then it's a money management game. That's how you extract wealth from the market. Okay, it's a different philosophy, a different way of understanding, but we have to maximize money management when the trades are going our way. And you need to write these things down before you actually jump into the market. So we are looking to go short again on UK 100. There is a sell zone. That's where you want to get to. If the market resumes and gives us a double top, perfect. Then you want a lower high. Okay, anywhere in the middle of the trading range, that trading range, do absolutely nothing. Okay, because down here it's a buy zone, up here it's a sell zone. If the market breaks beneath that, you always need confirmation of breakout, pull back, then jump into the trade. Okay, what is the blue line EMA? So I will use 2 EMAs here. The thick blue line is a 10 EMA, which I use to indicate the strong part of a trend. Okay, the thin blue line is a 20 EMA, and I'd look for trades and pullbacks of the 10 EMA. So any time, let's see if we can get it here. Okay, so here's a nice example. Okay, very strong breakout, and the thick blue line, the 10 EMA, is my indicator of breakout strength. Okay, it also just saves me drawing a trend line. As long as the market is bouncing off that, you know, and if it's set up your way, you want to take the trades. Okay, when the market breaks at 10 EMA, I know the trend is weakening, but I'm still looking at the 20 EMA to look for possible trades to jump in. Okay, last few minutes, guys. So the point is, please wait. Okay, let's just look at Hang Seng 50. So I like to trade the morning part of the Hang Seng 50. I'm showing this because trade management is absolutely critical. I mean, yesterday I made some good money, but trade management was the key. Okay, so this is high of yesterday, low of yesterday. Let's not worry about that. What I'm going to do, just to illustrate something quickly, I'm going to imagine that I was back with you guys yesterday when the market opened. So I would have had that high is a high of the previous day. And that would have been the low of the previous day. Okay, so all of this will not have formed. And I use that magenta line to mark the open of the day. So in that particular day, we're going to go down to it. That's on the 14th. Valentine's Day. I don't know if Valentine's Day is crept into your culture. But it's part of my family culture, and I make it a point to rock up home. This time I rocked up home with orange roses. You can imagine the rewards. So on the 14th, so that would have been the low of the day and the high of the day. And we were getting up. That's the day that we were trading yesterday. Okay, so my bias was short. Okay, usual stuff. High of yesterday, low of yesterday. Okay, 50% pullback, market might get pulled up to there. So on observing the very first candle of the day. Very first candle of the day. I said, fantastic, those went up. So market opened there. Went up, failed, reversed. And I thought most gaps close. So I'm going to take a trade and that high is above that. So put an entry there, got triggered into the trade and boom, got stopped out. What a pity. I'm always right, I'm always right 60% of the time. This 40% that I know happens, and it happened there. But that's perfectly fine. I had my 50% level, so I'm still thinking short. I don't worry about being stopped out, okay? Because when I execute the trade, it's on strategy. I've got my management. I've got everything absolutely clear in my mind. So when I get stopped out, I'm perfectly fine with that. Okay, otherwise, don't take a trade. If you're afraid of getting stopped out, do not take the trade. So don't run away. And now I got stopped out there and I wait. I'm saying, okay, I'm going to wait and see. I need separation. Okay, 6 candles. Let's see what's going to happen. The market is going to carry on or pull back, whatever the case may be. But lo and behold, we get to the 50% pullback and then the market fails at the 50% pullback. Okay, and having failed at the 50% pullback, I'm very comfortable based on my read of the market to jump into the market. So I executed a trade there, and my stop at that point, because I had seen this outside candle, put a stop there on that first trade. Okay, so got into the trade, market begins to move my direction. At this point, jump into an additional trade and carry on. And then the market closed at 6 p.m., so just about there. So as the market was coming to a close, I had a choice to make 2 trades in the market. Okay, already stopped out, that's perfectly fine. At that particular point in time, if I had closed my trades, okay, so what I did was I pulled my stops down to this level. Okay, so we see the open here, just above this trading range. I pulled my stops down to there. Let me just put it in for illustration. Okay, so at that stage, I'm kind of saying, okay, market is going to close. I have a choice for an hour. I can close my trades, take my profit. I have a profit on the first trade, a little bit of money on the second trade. If the market gaps up, hopefully the broker will close me and I might break even on these 2 trades, make a bit of money. I'm down there, who cares? Okay. Alternatively, my bias is still short. So I'm saying, okay, the market is going to close for an hour. I pull my stops down, made the decision whether I get gapped up or not. I'm very happy to leave the market as it is for the hour. And let's see what happens, because I'm always right 60% of the time. As it turns out, on the next open, bear candle, very good. Follow-up bear candle, very good. And I'm like saying, man, this is a day that you're going to make a fortune. Then the bulls come in and they spoil the whole party. And I'm like, come on, guys. I mean, there's a breakup, there's a follow-through. At least just, have mercy on me. But anyway, in that case, I know from having looked at chart after chart that when you get that kind of setup, the market is going to reverse, go into a trading range. I closed my trades, very happy to close my trades. If it had carried on, I would have found ways to get in. Closed my trade when I computed all of that with that initial loss. It was a 5-to-1 return. So that was worthwhile. And then we had all of this taking place. Point is, if we go back to the daily, just very quickly, the setup was here, guys. Okay, you had seen all of this. Trading range price action, lower high. This is trading range, all these tails. Inside candle breakout mode, but trading range price action. Okay, so when you see that, okay, the breakout beneath that trade range, most breakouts fail. Okay, so you kind of expect at some point that the breakout to fail, but the bears were strong, closed beneath the 10 EMA, closed beneath the 20 EMA. Market opens with a bit of a gap up. Let's see whether the market will break beneath that. And yes, I know most breakouts will fail, which is why, when I saw that failure, I closed the trade. But in that, it made a bit of money, which was worth all the weight of all of this. All right, guys, thank you very much. I am 1 minute over. Really appreciate your support, and we will see you next week.